Thanks for joining. I'm Will Woodall from CAP STRAT, and I'm joined with Mike Rarey from CAP STRAT. Hey, Mike.
Hey.
We got a pretty exciting show today. We're going to talk about the recent FOMC meeting and the rate hikes and look at the dot plots and talk about what that means, what it doesn't mean, and how we see things evolving from where the Fed has been guiding us. So let's first start by throwing up the dot plot and talk about the FOMC meeting that just occurred.
Yep. At every quarterly Federal Open Market Committee meeting, all of the Fed voting members release their projection for what they think the federal funds rate should be over the next few calendar years or at the end of the next few calendar years, as well as the longer term. And then you take all these different dots and you find the median, and that's how you get these lines. And it's supposed to be the consensus or the conventional wisdom of how the FOMC voting members think the federal funds rate or interest rates in the US are going to evolve over time, given inflation, given growth, given everything that they see in their models. And we had a dramatic shift in where the Fed is guiding and some very interesting dynamics in this median projection. We have an inversion at the end of the curve. So this is a huge difference from what we were talking about at the December meeting, just a few months ago, and an even more dramatic difference from what we were looking at a year ago.
Yeah, so a lot to dig into on this page right here specifically. Let's start with what we were expecting back at the beginning or end of last year.
Yeah, end of last year in December, the Fed was saying that, in 2022, we're going to hike 3 times, get the federal funds rate to 0.875%. That assumes 25 basis point rate hikes. So starting with the blue line, that's what the Fed was saying in December. And it was basically by the end of 2022, they will have hiked rates 3 times, continue their hiking cycle through 2024. And then that longer term dot basically saying the neutral federal funds rate is 2.5. That's what that longer term dot represents. So a neutral federal funds rate implies it is not too hot or too cold. Interest rates are not at a level that they would restrict growth and inflation. They're also not at a level that they would be stimulative to growth or inflation.
Okay.
And that is, even that December line is way different from what they were saying in March or early 2021. So that was a big difference in and of itself. But then going from the blue line to the green line in just 3 months, where you basically got 2 additional inflation prints and haven't even received a Q1 GDP number yet.
And what were those inflation prints? Those were all
They were hot.
7, yeah.
They were hot. They were north of 7, but they were basically in line with expectations. They weren't. Everybody knew it was a known that inflation was going to be hot and peaking somewhere in Q1. So there weren't many surprises on the data front.
And it was also pre-Ukraine data.
Right. Pre-Russia, Ukraine, and the implications of that for growth, inflation, et cetera. But with all that taken into account, now we have the green line. So now the Fed is saying in 2022, we're going to hike 7 times. So that would bring the federal funds rate to 1.875%. Now they hiked at the March meeting. So there's 1, and there are 6 more meetings left. So they're basically saying collectively, we are going to hike 25 basis points at every single meeting. And then they're going to continue their rate hike cycle into 2023, only about 3.5 more hikes. So saying we're going to do the majority of this rate hike cycle, we're going to get done with in 2022. It's going to be sort of fast and furious in terms of the rate hike cycle. And then we're going to pause through 2024. And then we're going to start cutting, actually, because our longer term estimate has now come down. So we think the economy no longer can support a 2.5% longer term federal funds rate. It's actually weaker than we thought. And perhaps it will be weaker because we're going to hike so aggressively in 2022, but now it can only support 2.375 long-term in a federal funds rate. So what you have there from 2024 to longer term is an inversion in Fed projections. And we love inversions. We love picking out inversions. Inversions are fascinating. But basically the Fed saying, we are going to raise the federal funds rate very quickly to a level that is restrictive to growth and inflation. We are willing to sacrifice some economic growth, some health of the labor market potentially, in order to win this long-term fight against inflation. And they don't often do that. We don't often see inversions in this curve. The last time we saw that was around 2018. And some of you may all remember what ended up happening at that point. So in 2018, the Fed also guided to an inversion, and they clearly overdid it. And economic growth did slow quite dramatically.
Right.
The actual Treasury yield curve inverted early in 2019. The stock market and basically all assets had one of their worst years in recent memory in 2018. Cash was king. Bonds sold off, equities sold off, and in December of 2018, the S&P was down almost 20%. And after all that ugliness, they reversed course.
And so we had a lot more to dig in here. So compare and contrast 2018 and that cycle to this.
Yeah, that cycle. So in 2018, inflation was not running north of their target. So this is very different. I mean, the Fed hasn't seen, since the invention of the dot plot, we've never had 7% inflation. Right. So we've never been able to observe that. So that's the biggest difference. The amount of money, the valuations of asset prices, all of those things are higher. It's much more of a high wire act this time than it was back then.
Right. So do you think this is sort of will play out differently than 2018?
Yeah, that's a good question.
Maybe a better question to ask is this significant ramp up in rate hikes. Mm-hmm. How will this impact growth?
Well, there's no doubt it's going to slow growth. I mean, that is the point. They're acknowledging we have an inflation problem. The only tool we have is to restrict growth through tightening financial conditions and reducing the supply of money. Right. That's it. The Fed's tools will do nothing to solve supply problems. Absolutely nothing. If anything, they will only make them worse. So they're saying we are going to purposefully put our foot on the brake to slow growth, slow demand, to allow inflation to come down, mm-hmm. potentially even risking a dramatic slowdown in growth, all to win the long-term inflation war.
So potentially putting us towards or in a recession, perhaps?
Perhaps, and that's why if you look at the Treasury yield curve and how it's starting to price in all these expectations for the Fed, it is starting to sound some alarm bells. You're seeing longer-term inversions and things that typically start to happen when there is a real risk of a recession out there in the next 12 to 24 months.
Yeah. So we'll move on to the next chart, but before we do, just noting that the long-term rate of 2.5% that was projected is actually right at where the 30-year yield is right now.
Yeah.
What does that tell us?
Yeah, exactly. So what this is basically saying is if the Fed actually delivers on this, the whole curve would effectively be inverted. The 3-month or the federal funds rate would be the highest interest rate across the curve. Because the 30-year is already pricing this in, right? Mm-hmm. So if the Fed delivers in line with this, we wouldn't expect the 30-year to go up. In actuality, it probably has more potential to go down. Right. So the whole curve would be inverted at that point. And let's remember, they're going to get all this entire rate hike cycle done by mid to late 2023. Yeah. So this is saying mid next year, we could be seeing a completely inverted yield curve if they go through with this.
Yeah. Well, let's talk about flip up the next slide here and talk about the Fed funds versus the 2-year yield, because we've seen that rocket higher, and then talk about how that, compare and contrast that to how it affects the rest of the curve.
Like we're saying, the Fed has only hiked rates once. Right. They've only hiked the federal funds rate once. The market controls the rest of the interest rates across the Treasury yield curve. And so what you see typically is the 2-year Treasury note yield, which is a short-term interest rate that is controlled by the market, starts to price in the path of the federal funds rate over the next 2 years. And so the 2-year shot straight up. So the market believes the Fed. The market controls the 2-year. They dramatically changed the 2-year Treasury note yield. The market believes the Fed is going to go through with this over the next 2 years. And so we're already starting to see, if you look at where the 2-year is versus the 10-year, that spread is very small. Mm-hmm. It's nearing inversion. And so already starting to see, hey, the market believes the Fed. If the Fed follows through with this, we're going to be talking about yield curve inversions, a dramatic slowdown in growth, potentially a recession.
Right. And as you look at the rapid market response to this, it's a chicken or egg thing. Which comes first? Is the FOMC that causes this, or is the market causing the FOMC to raise the rates?
So the Fed has really only provided this much forward guidance, things like the dot plot, et cetera, since 2012.
Right.
And what we've seen since the last rate hiking and cutting cycle is the market leads the Fed. The market tells the Fed what is necessary. And that was a big part of this last FOMC meeting. The Fed basically just guided to what the market already had priced in. And so what's going to happen first when the Fed has done too much, what you're probably going to see is the market starting to tell you that first.
Mm-hmm.
The 2-year note yield would eventually start to come down, saying, actually, Fed, we don't think you're going to get through all these rate hikes.
Right.
Growth is going to slow too dramatically. Before the 2-year comes down, you're probably going to see the 30-year start to come down, and then the 10-year start to come down. So generally, the longer-term yields start to signal the Fed has made a mistake and needs to reverse course much quicker than the shorter-term yields. But that's how you will know. That's why we look at things like yield curve steepness, longer-term interest rates, because they actually are guiding the Fed.
Great. So the volatility we see on this chart, where rates skyrocketed in the last several months, how quickly or how volatile could this reverse, or how could it continue?
Yeah. So at this point, the Fed has guided to the market, and it is a known, and it is priced in that the Fed is going to hike this dramatically. That is priced into the bond market. So at this point, you should start to see longer-term interest rates settle down. So like 30-year, it should be way ahead of this.
Mm-hmm.
It should start to stabilize now. The 10-year would be next. And as we get down to shorter-term interest rates, you say, how much potential is there for the 2-year to move higher? Well, usually the 2-year will follow the federal funds rate and be supported by the federal funds rate. So if the Fed does get the federal funds rate up to 2.75% at the end of next year, we would expect the 2-year note yield would go there first, actually go there as well.
Mm-hmm.
So there is potential for this to move higher. There also is potential, if you look at this chart, especially during the red shaded areas, when the Fed reverses course, the 2-year comes down dramatically,
right,
very quickly.
Yeah.
For example, during COVID,
Yeah.
or when they started cutting in 2019, when they started cutting interest rates. So, but this rise we've seen has been probably the sharpest increase in 2-year note yields we've seen in sort of the post-global financial crisis era, certainly.
Great. And I guess last question, what's the lead time on this towards a recession, or when will we see the growth slow down as a result of these market raising interest rates so aggressively?
Yeah, you should already start to see it because, for example, things like mortgage rates have already jumped up dramatically.
Yeah.
The yield curve is starting to flatten if you look at the 2s and 10s, and a lot of folks say, well, that means bad things for the credit cycle and for lending and banks' net profit margins. But banks don't borrow money at the 2-year Treasury note yield.
Right.
The government does.
Yeah.
Banks borrow much closer to the federal funds rate.
Yeah.
So this is a great lead. It's not a great timing tool. What's even better is when the 3-month gets up above the 10-year and the 30-year. That's when you know, okay, the Fed has really overdone it now. Now we should really be talking about recession, economic slowdown in the next 12 to 24 months. But as we're saying, we could get there the end of this year,
right,
or next year.
Yeah.
So, a 1-year lead on a recession is basically what this tells us.
Yeah. Yeah, a lot of great stuff in here. What are the things we're monitoring day to day on this?
Yeah, so we're definitely monitoring the 2-year. If the 2-year starts to come down, right now the biggest thing is monitoring longer-term interest rates and where they are relative to short-term interest rates. And then, all the things that matter. So prices, liquidity, growth, inflation, recession.
Yeah. It's going to be an interesting year, a lot different than it was the last 2 years.
Yeah,
so
for sure.
Thanks for joining us, and we'll look forward to updating you on the progress of this. And if you have any questions, obviously give us a call.